All right, so this is our last Zoom hour session, and I do want to spend just a little bit of time going over some income statement problems. The last two problems that fold in other comprehensive income to the other topics we've been talking about in the income statement. I also want to just kind of, cover ideas about the final and give you some direction and hope to help you understand how would be best to prepare for the final. But first, we'll turn our attention to these two problems, and then we will move along to a more general discussion about what to expect for the final exam. So I'm looking at the last two problems in the chapter four problems, and these are pretty pretty template, how formatted in terms of how I tend to ask questions. I give you a list of expenses and revenues and different things going on with the company's income statement, and then ask you to walk through some things. There'll be an EPS question here, and updating the balances of retained earnings and accumulated other comprehensive income here. So, basically creating that income statement, finishing off with the required disclosure of EPS, how the income statement affects and informs these two accounts in particular on the balance sheet, and then a discontinued operation piece. So I think both of these are very good problems to kind of get a hold of. I might work one in full and then one just a little bit. But without further ado, all right, so we have to get the following information, determine relevant subtotals on a multi-step income statement, and then we have the following. By default, it's pre-tax, but just be sure that you recognize whether an amount I'm talking about is pre-tax or after tax. I tend to give everything in pre-tax, but so if it doesn't say or you're not sure, pre-tax is a safe assumption, but I tend to tag everything pre-tax. This is for the year 20X7. Apply a 40% tax where it's needed. And so, yeah, we have our random collection of accounts now. We need to organize into the multi-step. There's a lot of ways you can go about doing it. Of course, sales revenue is always our first thing. Remember, again, I'll call your attention to this net. It will be broken out on the final in terms of I'll give you perhaps some sales returns. I'll give you perhaps some sales discounts, and you'll as separate accounts, right? Separately listed in here. And then you'll have to know to subtract them from what I will provide as just sales revenue. And if I provide these separately, of course, the net goes away because they haven't been netted yet. So we start with our sales revenue. That's always the top line of an income statement. 93, 9.3 million. And then the next thing I'm always looking for is a cost of sales, cost of goods sold here. We've taken that into consideration. This, of course, when netted against our sales revenue net, gives me my gross profit. So $3.6 million of gross profit for this company. Now, we have a gross profit. The next thing we want is SG&A and other operating expenses. So I will list the SG&A first. Wage expense would be SG&A, 1.2 million. And hey, that actually looks like the only thing that would be tucked into SG&A that is provided here, just that wage expense. We do have other operating expenses. Restructuring costs are operating, typically not included in SG&A because they are for two reasons, really. One is that it's not going to be a persistently recurring expense. We tend to embrace as a company restructuring costs for a few periods, and then they go away after we've done all of the finagling of our corporate structure, perhaps let people go. After that has happened, these tend to drop off and will not continue. Also, this does tend to indicate that, I mean, we're not just restructuring for the hell of it. There is hopes of some gains in profitability and efficiency that will result from our restructuring activities. R&D also separately disclosed from SG&A because when companies engage in R&D and develop intangible assets like patents, they are not allowed to record an asset on the balance sheet. And so this gives investors an idea of what intangible assets might be under development, and actually is used by investors as a sort of quasi asset when they're valuing a company's future prospects, right? So this $200 for investors and stock analysts is much more like an asset than it is an expense, even though we're listing it as an expense and even though US GAAP defines it as an expense. Depreciation expense, I don't have the amortization tagged. Again, separately disclosed from SG&A, usually so analysts can back this out to form EBITDA, and that they utilize that and employ that in a lot of their valuation models. None of these are positive. All of them will be subtracted from 3.6 million. So we got, uh, whoa, 1,950,000 plus 11,000. All right. So after I subtract this, I should have operating income of $550, $550,000. All right. Now that we have our operating, we go to our non-operating piece, or our other income. We've already used a bulk of these. I already brought in depreciation expense. Interest revenue, that looks like the only other income or non-operating income that's going on with this company. They have 600,000 of that. So that brings it to 1150. Remember, of course, this is revenue, so it's positive. So I am adding that. Just be careful that you don't get into that subtraction mode and start subtracting everything. This would then be pre-tax income. I want to take the tax rate from that. So 1150 times a 40% tax expense gives me 460,000, and then knock that off. 690,000. Now, what I'm going to call, oops, not there. What I'm going to call this subtotal depends on whether there's discontinued operations or not. If there are no discontinued operations, this is net income. But in this case, we do have discontinued operations. We also have, it looks like, two pieces here that I ignored, right? Because a foreign translation that signals OCI, unrealized loss on pension costs, pension also unrealized should scream OCI at you. Those are two of the four OCI transactions that we do not include in net income. We do have discontinued operations. We have an impairment here. We have a loss on operations from the discontinued operation, the discontinued division. So this is not net income. This is income from continuing operations. And now we do discontinued operations. So We have the impairment already given to me, already judged the book value and the fair value of my net assets of the discontinued operation, and came up with 700,000. Same with this, already have the overall net profitability of the discontinued op. So we took all the revenues less all the expenses and came up with an overall loss. Both of them are going to be negative to net income. Impairments are always losses, and this is a self-described loss. So strip the taxes out of the $700,000 impairment, and 40% of 700 is 280. Take that out. That would be $420,000 net of tax. And 450 is my loss on disc op. But of course, we net of tax. And 450 should be 290, but let me check that. 270. It's a good thing I checked it. $270,000 net of tax. And so, of course, this is just that stripping away of a tax effect here. 280,000 would be the tax savings from recognizing a $700,000 loss, right? We do save on taxes because if we recognize a loss of 700,000, we report less taxable income. And then the amount remaining after taxes are taken out is the $420,000 loss. And then you do the same thing with the 450,000 as well. The tax effect would be 180,000. Oops. And the remaining amount is 270,000. All right. I do find that, in terms of where I take points off of, I'll take maybe a couple points off up here. This is where the bulk of the points tend to disappear. So make sure you know how to do this discontinued operation section. It is simple, but seemingly not easy, just from prior experience with scores and such. I do also want to make clear that um, with discontinued operations, you should be okay if I gave you a table similar to this in case number three. If I gave you a table similar to this, but wedged it into this formatting, right? So you have all of these are my continuing operations. And then I would have a table right under here that said, these are the things from the disc op, right? So make sure that you're comfortable, not just when I give you straight up what the impairment and what the loss are, but that you understand how those things come about, what aspects of the discontinued operation you need to look for when you are preparing that, preparing those calculations. And so take this, looks, that's an interesting phenomenon. So now if we take the 690 and then subtract 420 and 270, we're going to come up with zero net income. And I'm going to take a moment to check this. All right, so looking this over and consulting my student who's here with me, this was a miscalculation at the very outset. And just as a note, if you were to commit this sort of error on the exam, I probably would take half a point off. So the problem here is I started off and I put the right amounts here, but did the wrong math. This should be 4,600, not 3,600, which of course throws everything else off. And I realized very quickly in my days as an accounting professor that if someone screwed up here, I couldn't count them wrong the whole way down. So it's something huge. Like if you screw up and leave off, sales discounts or sales returns in here, then that's a point off, but I'll follow your error the whole way through. So this should be a million higher, which makes this should be a million higher, which means my pre-tax income should be a million higher, 2,150,000, which changes the tax expense to 860. And then subtract that from 2,150,000. It should be 1,290. Okay, I didn't even have to scratch out numbers, thank God. So that should be 1,290,000. These are unaffected. But of course, now 690 will result in $600,000 in net income. So now we're on point. And if this is an Amazon delivery, my dog's going to go crazy here in a bit. All right, so net income is 600,000. Remember now, this is the end of most companies' income statements, and they will not include OCI as a part of their income statement. So I'm going to do what most companies would do, which is then carry this over to a new financial statement where we begin at net income. This is my statement of other comprehensive income. And we include the two pieces that remain that we hadn't, that I flagged as OCI. So we have an unrealized foreign translation gain, a gain. This is pre-tax, just like all of the numbers up here are pre-tax. So we need to net taxes out of that. So 40% of 110 is 44,000. And that makes the remainder 66,000. Sorry, writing in percent there. It's 44,000. The remainder would be 66,000 after I subtract 44 from 10, and that's the 60%. This is my net of tax amount here that I want to transcribe over when I list this. And we can just call it, foreign or yeah, foreign currency translation, FCT, net of tax, 66,000. The unrealized loss on pension costs, so I'll just call it unrealized pension, also needs to be stripped of tax. And 40% of 560 is 224,000, which makes the remaining portion 336,000. That is a loss. This was a loss. Remember, that was a gain. And we have a $336,000 loss. And when I combine those, I get $330,000 of comprehensive income. All right, so this would be all, the full multi-step income statement with all relevant subtotals. And just ensure, the two things I find students will mess up most frequently are the things that come below tax expense, the discontinued operation and the OCI items. So make sure that those are correctly filed away. Why we're netting tax, to net tax, and that should be a pretty successful venture for you. So moving to the next piece, looking at um, the EPS. So it says that the company had 2 million common shares outstanding for the year 20X7 and $100,000 of preferred dividends. So we're going to need to provide three EPS disclosures, and we provide three because we have a discontinued operation, we want to take this as one of our subtotals, net income as one of our subtotals, and the third EPS figure will be the effect of the discontinued operations. So our first EPS is all about the continuing operations. So I'll just say continuing ops EPS is equal to 1,290,000 less the preferred dividends, which were $100,000 of preferred dividends. We're also going to need the weighted average common outstanding, which is 2 million. So we have those two pieces of information, which are vital. So we got dollars on the top, shares on the bottom, and this will come to 1190 divided by 2 million is, if we round, 60 cents per share, which I rounded from 59, 59.5 cents per share. All right. Then we have the effect of discontinued operations. So we have basically our effect of the disc ops on EPS. This is not an EPS in itself, it's a change in the EPS that was brought about by our discontinued operations. $690,000 of a loss in total divided by 2 million shares. So this will drag the earnings per share per common share down by 35 cents. Remember, of course, it should be negative because the numerator was negative, the denominator is positive. And again, I rounded from 34 cents, 34 and a half cents. And then finally, we take our net income. So our EPS, our net income EPS is 600,000 minus the 100,000 of preferred dividends divided by 2 million shares outstanding. And that comes out to a solid, no rounding needed, 25 cents. Oop, don't need the parentheses, sorry. Just 25 cents per share EPS. And again, we can check that calculation by just noticing that our EPS from continuing operations was 60 cents per share. The effect of the discontinued operations was 35 cents, which leaves me with 25 cents net income EPS. And so that math should work out. And is a great way to check yourself to make sure you did the that you did the EPS correctly. Now notice that none of these EPS involve comprehensive income, and we don't want it to. Remember that investors are not keen on watching for comprehensive income. They don't care if this is, say, you know, whatever is typical for some company, let's say $10 million. If their net income is 10 million and they had $30 million of loss in their comprehensive income, which came out to comprehensive income of a comprehensive loss of 200 million or whatever, 20 million. I forgot the numbers I was using. But if this is screamingly low, if this is a loss and this is great, showing profitability, we really don't care about what's going on here. The presumption is this will change given time. Whereas this tends to be a lot more steady than comprehensive income. And because of that lack of persistence in comprehensive income, it doesn't earn a spot in an EPS calculation.